Today is Thursday, September 11th, and this is a post-market review for the stock market activities today. Here is the agenda of the day. Per usual, we have important discussions today, heavy discussions. We will cover interesting headlines, in addition, of course, to the absurdity of Peloton's valuation and what impact and signal that could reflect from the market. We have the discussion whether the correction is over or not. Looking at the froth in Peloton stock might answer that question. And of course, we will cover the whole Nikola fraud saga. It's getting very, very interesting. We will cover that in details. And then we have important charts to look at, charts developments. We will look at the SPY, the triple Qs, the dollar index, the TNX, and the VIX. I will show you how the chart of the dollar index specifically predicted the outcome of the triple Qs chart today. And of course, we have an important discussion at the end, the conclusion. We will discuss that domino effect theory that could happen and get triggered if we see a continuation of the sell-off next week. So here we go. We have a mixed day in our hands. The Dow Industrial Average closing in the green, 131 points, or a gain of 0.48%. The Nasdaq continues to get hammered and lag the overall market with a decline of about 66 points, or 0.60%. And the S&P 500 barely in the green, a gain of 1.78 points or 0.05%. And moving on to the sector's performance, leading the day, the boring sectors, with the gold going to materials, the silver going to industrials, and the bronze to consumer defensives. Leading the laggards of the day is real estate, followed by technology and communication services. And now, moving on to review the futures market. Today we saw a rebound in crude, lumber, copper bouncing from the losses earlier in the week, with lumber, of course, building up on the gains. So the question here, did we reach a bottom for lumber? Would the rally resume again? It is too early to say. However, I believe that the housing rush mania is coming to an end, and lumber is having a dead cat bounce and will continue and resume to the southern destination. And the gainers of the day, lean hogs. We talked about lean hogs yesterday skyrocketing due to the increased Chinese demand and the shortage of supply due to the outbreak of the disease in Germany. And building on the gains, canola, corn been on a tear recently. And of course, soy products rallying as well. Here is a trade. I opened some contracts on soybean oil overnight because I saw in the charts the bullish wedge-ish formation from which soybean oil would break out. And as you can see from the chart, soybean oil managed to break out as I expect. I will hold these contracts for a little while because soybean products will benefit from the surge of Chinese demand. And of course, leading the laggards of the day, we saw a decline in metals, in silver and gold specifically. OJ got hit a little bit today, and so did rough rice. And shifting to the big casino, the gamblers market, how did the tables do today? As you can see, the gamblers are a little shaken off. They're a little scared. They're not buying and stampeding on calls to the same magnitude they were doing so a few weeks ago. That is certainly good, but it is not enough to kill the momentum and the recency bias from these gamblers to hop back into the rush to buying calls again in the weeks to come. More work and more shake-off need to happen in the market. And of course, leading the day, Apple, with about 2.8 million options traded today. About 59% of those are calls. Notice that you're not seeing 75, 85% calls. You're seeing now 59%. And in second place, per usual, Tesla, Apple and Tesla are the gamblers' favorite names. 1.2 million options traded today. Oh, about 55% were calls. And look at number 3, Nikola, with 520,000 options traded today, approximately, of course. 31% were calls. So the gamblers are assuming that there is more pain to come in Nikola. Mind you that the name got hammered severely the last 2 days. So any good news that will come out of Nikola next week will cause a massive short squeeze. So the risk versus reward in Nikola stock, or options in this case, is actually buying calls. And of course, notice here that we have Peloton in the list with about 62% of those options traded today for calls. I happen to be watching Peloton stock today closely because I have a short position in the name and I do have put options that I closed at a profit today. We will talk about that in a little bit. But since I was watching the action in real time, I can tell you that the majority of these call options were bought in the name, while Peloton was trading up 3%, up 5%, up 7%. So all of these options, or I shouldn't say all, but most of them are losing money now because Peloton reversed and closed about 4% in the red. When an overbought name pops 10% pre-market while we are in a revaluation correction, this is a gift from the skies for you to short the name by buying put options. It was pretty much handed to me in the morning and I made lots of profits. But those who bought calls, I don't understand the rationale behind that. The name already popped 10% plus in the morning. How much do you think it's gonna rally? There is no short covering rally in Peloton. The float is only about 3% shorted. So again, you need to gather lots of facts before you jump the gun and open options trades. And now, moving on to the headlines that shaped the day. And the first headline we saw, of course, is core inflation has risen by a little bit. And of course, the media had the massive orgasm in the morning, painting the increase in inflation as a healthy indicator of the economic recovery, which is complete bullshit. I gathered some information for you to show you the inflation in everyday goods for the average American. And as you can see, prices increased in the second quarter of the year in goods such as eggs, detergent, cheese, diapers. Mind you that a lot of us lost their jobs, their incomes, our savings are drained. Meanwhile, we are fighting and facing this inflation in goods that we need on daily basis. However, the Fed somehow believes that we need more inflation in the economy. Notice that the prices of onions actually declined. So the Fed is telling you if you're mad about the prices of everyday goods increasing, go ahead, grab some onions and cry like a bitch. And of course, speaking of the great economy that is recovering due to the increase in inflation, let's check out on the health of the economy. Here is a report saying that bankruptcy filings have skyrocketed in July and August. Matter of fact, up 244%. Does this sound like a recovery to you? And of course, banks are now pushing more cash into their reserves to face the bankruptcy and the default apocalypse that is about to hit small and medium businesses, in addition to large businesses in the oil and gas, aircraft, and many other sectors. But don't be alarmed, Wall Street will be just fine. Case in point, we have Carnival Cruises and other zombie companies getting access to an ocean of liquidity from the Fed at pretty much zero interest rates. While bad behavior from Wall Street is being rewarded, small and medium businesses being decimated. And of course, you could say, hey, Carnival Cruises, it's not their fault. COVID is an unforeseen event, you can't blame them until you actually do the homework and you find out that these airlines and cruise companies spent their profits from the last few years in executive bonuses and shares buybacks. But somehow we need to keep them afloat right now. Continuing. We do have a junk bond mania that would come hand in hand with the bankruptcies in these very speculative companies. Matter of fact, $40 billion in junk bonds were issued after the COVID crisis. Now, the dummy investors, of course, thinking that the Fed has their back and the Fed is just scooping junk bonds like there is no tomorrow. If you look at the balance sheet of the Fed, it actually didn't buy lots of junk bonds. Dummy investors bought junk bonds assuming that the Fed is gonna buy it from them at a higher price. And of course, this is all fun and games until you realize that about 8% of these junk bonds will default in 2021. And when these dummy investors look around for the Fed to cover their asses, the Fed is not gonna be anywhere to be seen. You bought junk, you got junk. And speaking of junk, here is SoftBank. You're of course aware of the gambling from SoftBank lately, piling up and buying billions of dollars of call options. There was a severe backlash this week against SoftBank shares over in Japan, down over 13% for the week. And now SoftBank, of course, saying, hey, we're gonna reconsider our strategy, and we heard reports and rumors today that SoftBank closed the majority of their call options positions. That could explain the volatility that we are seeing in the market right now. And moving on to news from Apple. Apple, of course, they have the big reveal next week, which could be a potential bomb. We'll talk about that in the conclusion of this video. But for now, what we know is the App Store rule that every video game maker has to list each video game as an independent entity in the App Store. And the reason for that, of course, because app developers figured out that they can circumvent the majority of Apple fees if they create one app with several video games offerings. And now the Apple mob, and of course they are a mob because this is not a legal or legitimate way to create corporate revenue, shaking down your app developers for more cash, threatening them that you're gonna break their kneecaps if they don't pay up. The Apple mobsters are now saying we want every game to be listed independently so we can siphon revenue from each game. We want every penny to be counted and we want a cut from every penny you make. The Apple mob decided that your phone is their territory, even though that you already paid for it and you own the damn phone. They've decided it is their territory and they are entitled for a cut from each and every transaction you make using that phone. And of course, we heard news today, an update in the whole TikTok saga. China is firing back right now, saying no, we're drawing a line on the sand. We would rather see the TikTok US operation closed rather than being sold from a strong arm threat from the administration. So this is about to heat up. It's about to get uglier than it already is. And you saw, of course, shares of Oracle, Walmart, Microsoft, all the names that were involved in the TikTok mania giving up today. And let's move on to Peloton. Peloton released earnings yesterday, and the analysts and the media had a massive orgasm about it, saying, hey, look, things are not overvalued. Peloton justifies the froth in the market and it's growing severely and significantly. But of course, they did not tell you that the company is valued at about 25 billion bucks, meaning that you are paying for about 20 times more the revenue that Peloton is about to generate this year. And here is the problem I see with Peloton. It is an indication that the correction in the market is not over yet, and it will resume stronger and more aggressive than before. What you've seen the last few weeks is just a little teaser. Because here is a company that benefits from the have and have-nots economy that we have these days. You've heard the earnings from Restoration Hardware, a company that caters to the haves. These companies have no problems whatsoever until they become overvalued. And this is the case of Peloton. Their customer base is a small niche of wealthy people who can afford $4,000 or $5,000 bike. And that's what it is. It is a bike. And of course, they buy it sometimes not just to exercise, but to go with their friends in the Hamptons and say, oh, my Peloton, did you see? Oh my God, so amazing, that Peloton. It's now becoming a status thing for these morons. Once you reach full penetration of this very small, tiny niche, your next avenue to create revenues to milk them for more cash by offering subscriptions and more accessories and products. And of course, I've heard a lot of stupidity today with people comparing, oh, the Peloton valuation is justified because Peloton is just like Netflix. How stupid can you be? Netflix has an appeal and an entry price of about $10 that can appeal to a wider mass of population. You're comparing $10 subscription versus a $5,000 plus bike. Are you insane? And of course, when you look at the valuation of Peloton, it is at 25 billion bucks approximately when you compare it and illustrate it side by side to the valuations of the entire U.S. airline industry. Peloton is now bigger than any U.S. airlines operative. And I know that the airlines are in trouble, etc., etc. But the asset value alone in airlines, the value of their jets, eclipses all the stupid bikes that Peloton has. Yet somehow Peloton is valued ahead of all these airline companies. This is the mania, the froth in the market that is not out yet. The correction will resume. It will hit Peloton. It will hit DocuSign. It will hit Zoom and all the other names that got out of whack in terms of valuations. And by the way, they're talking about Peloton as it's gonna appeal to everybody. It is a bike. Cycling is for bitches. It is not a real workout. You get in the morning, you hop into your Peloton bike, you read some vegan recipes while you're exercising. That is not an exercise. An exercise, a legitimate one, requires weights, treadmills, and a boxing bag. Other than that, don't tell me that you are exercising sitting in your ass pedaling a $5,000 bike. That is valued at 25 billion bucks. Moving on, we have the whole circus and the saga with Nikola and the accusation of Nikola being a fraud from Hindenburg, and now of course Citron research piled in Nikola throwing uppercuts, jabs left and right, bruising Nikola further. Nikola was down double digits today. And of course, don't expect any intelligence from the moron chairman who is leading Nikola, Trevor Milton. He's trying to be an Elon copycat, trash talking, thinking as if this was a sport. If I'm a shareholder and this is the guy who's leading the company, I am saying goodbye to my shares. I want an adult in charge, not a child. Trevor needs to be professional and he needs to grow up. All he had to do is issue a professional response saying that the accusations are false. We are seeking legal counsel. We are suing Hindenburg and Citron and any short seller who is bad-mouthing and spreading false information against our company. We will fight back and we will release with full transparency all the facts. Furthermore, he could have reminded investors with the case of Barry Minko. I don't know if you're old enough to remember the whole Barry Minko versus Lennar saga, but Barry Minko is a scam artist who came out with a scathing report against Lennar, accusing them of fraud, and then he got exposed and he ended up in jail. However, there was significant damage done to Lennar stock and Lennar shareholders. Here is a little bit of that case from CNBC's American Greed. All what Trevor had to say is this Hindenburg person is the new Barry Minko, and when we are finished with him, this son of a bitch is going to jail. However, he released some stupid video with him swearing and then saying, oh, I need a week to come up with all the excuses and the case. He said, I'm not going to talk about the case due to the legal counsel advice. And the next thing, he creates a video talking exactly about the case. What the hell are you doing? Moving on to the heat map, and as you can see from the heat map, it is a muted picture. Technology getting hit the hardest. You see some of the laggards rallied today in materials, industrials, consumer defensive, cyclicals, however not the vaccine-related names directly, as in airlines, resorts, casinos, those lagged, of course, under the comeback stocks, which we're going to review in a little bit. But you can see again the value is outperforming even in the technology sector. Take a look at Intel versus Nvidia. Intel managed to close in the green, Nvidia in the red, which is another proof that this correction's purpose is to fix the overvaluation problem in the market. And the names that are overvalued the most will get hit the hardest. And switching to the vaccine rotation trade, an update, nothing happened today. It is still muted. We haven't seen the rotation manifestate itself in a meaningful way yet. Granted, the momentum names are getting hit harder, but an example of a rotation would have been today, for example, selling Peloton and buying Planet Fitness. We didn't see that happen today. Both closing in the red. So we are continuing to track and watch out for the rotation trade, whether it's going to heat up in the coming few weeks as the NASDAQ and tech names get hit a little bit harder and more cash comes out of these names. We will see whether the cash will rotate to the comeback stocks or whether it's going to stay on the sidelines. And now moving on to the charts analysis, starting with the chart of the SPY, the S&P 500. From a 15 minutes chart, you see the action today started negative right away when the SPY failed to reach the upper limit of the breakdown candle we've seen yesterday. It didn't get to it and it reversed before that. So that was a very bearish sign for the SPY. However, on the bright side, the SPY managed to catch support at 322.80. Whether that support will hold or not, we will see next week. And when we switch to the daily chart, the positive news here is that the SPY held its support. The negative news, the bear side, the half-empty side, is we're seeing the bear formation manifestate itself here. You are starting to see the beginning of the second leg down from the bear flag. We will need to see confirmation of that next week. And when we look in the weekly chart of the SPY, the good news is we don't have a negative crossing in the MACD yet. The bad news is this is going to happen. It's just a matter of time because algos are taking control and algos will follow the technicals. And now moving on to the chart of the triple Qs, the NASDAQ, and you can see from a 15 minutes chart, the action was flat, starting flat, flushing down, and then a mini recovery at the end. Here are a few tweets that are released in the morning. Number one, talking about the reversal in the NASDAQ futures overnight as an indicator that the NASDAQ will weaken, or the Qs will weaken as we open for the regular session. And as you can see, here is the futures chart right in front of you, the horizontal lines showing the regular sessions, And in between the overnight session, you see the reversal before we hit the April trend line. We couldn't capture it and we reversed from it. That was the first indication that the Nasdaq will be weak today. And of course, the second indication here was watching the dollar index chart. The dollar index started to rally in the morning, and that was a bad signal for the Nasdaq. You're seeing the correlation between the dollar index and the Nasdaq. We talked about that in the last few days. And the number I had in mind was the 93.30 in the dollar index. As you can see, this is a 1 minute chart of the dollar index, and you can see that the dollar index tried to knock once, twice, a third time that came close but not quite. And in the fourth knock, it managed to break the resistance of 93.30. When I saw the behavior of the dollar index knocking and trying to break higher, for me, that was an indication that the Nasdaq, the Qs, will reverse. And you've seen at the end of the day, when the dollar index broke that resistance, now support, and closed below it, you saw the Nasdaq recovering at the end of the day. And here it is. I'll put them side by side or on top of each other so you can see the correlation for yourself. A 1 minute chart of the dollar index and a 1 minute chart of the triple Qs. You can see the correlation in the Qs at the 271 level. As the dollar index was knocking at the 93.30 resistance, the Qs on the other side started knocking at the 271 support until they broke it. However, time-wise, the action in the dollar index happened a few minutes before. That was your leading indicator. You gotta pay attention here. And when we switch to a daily chart of the triple Qs, the good news is we held the 270, 271 support. The bad news, we have a bear flag formation and we are already forming the second leg down, the start of the second leg down. What about from a weekly perspective? The bad news is the Qs have the negative crossing in the MACD, crossing the blue line, the average, and making red impressions. That tells you that this is just the beginning of the correction. And the good news from a weekly perspective is there is no good news for the Qs. The only good news is we have the Fed on Wednesday. Jerome is going to speak, and the market might need Jerome's plunge to stop the pain, especially if Monday and Tuesday end up being painful days for the market. And moving on to the TNX chart that tracks the 10-year Treasury yield. Another day and we saw the yields going down, signaling that some investors are moving their cash to buying bonds. That is not a good signal for the stock market. Granted, it is still a small move. It is not a major move that would indicate panic to buying bonds and moving from stocks, but it could be a leading indicator. And moving on to the final chart of the VIX. From a daily perspective, you could see that the VIX popped and it's starting to give a little, moving back to the 20 days moving average and the support, and perhaps it will catch a bid from these levels, exploding higher again. Needless to say, it was a down day for the VIX. And when we switch to a weekly chart, you can see that the MACD crossing is still intact, making green impressions, and it looks that it's looking for a bigger crossing of the MACD indicator. Now here is a point that I want to address. Some traders messaged me and they said, hey, the market is down, tech is down, the Nasdaq is down, but the VIX is down too. The VIX is not moving. What is going on here? As the market is crashing, the VIX is moving down. How do you explain that? Here is the formula for calculating the VIX. You don't need to know the details, the mathematical details, but you need to know that the VIX is calculated by calculating the spread between calls and puts for the S&P 500. Now, one explanation is, as you've seen today, financials rallied a little bit, industrials rallied a little bit, materials rallied, so did consumer defensives. The S&P 500 has more sectors than just technology. So if the VIX is tracking the S&P 500 and you have one sector down, but the rest of the market, the S&P 500 in this case, is in the green, don't expect the VIX to rally. The VIX will actually be muted or even closing in the red. The second explanation could be because we've seen in days where everything is down, yet the VIX is also muted or up just slightly. That could explain complacency in the market, or market participants are not buying protection. However, I maintain that the VIX will continue to rise, and it is an opportunity to buy the VIX. The consolidation and the little give up that you've seen in the VIX this week was an opportunity to buy and open positions in the VIX, because we have an election season that's about to get very heated. And we know from historical examples that the VIX becomes elevated during the elections season. And now let's move on to conclude the video. We do have important events happening next week. Number one is the Federal Reserve statement and Jerome Powell speech. There is a little bit of psychology here, specifically during corrections. Big market participants could crash the market on Monday and Tuesday to send Jerome a message that we need more help and more support. Because if the market manages to recover on Monday and Tuesday, then there was no need for the Fed to issue further support. We know that they're not thinking about increasing interest rates, but they have more tools left to prop up the stock market. The second event is Apple's conference. What if the conference does not include revealing the new iPhone and they're just revealing a bunch of iPads and Macs? That would be disastrous for Apple and for the rest of the technology market, because it will say we have no confidence that the consumer demand will meet the release of the new iPhone right now. We don't want the iPhone to bomb, so we're going to delay the release of the iPhone. That would be disastrous for Apple, but for the market as a whole too. And the third point and the last point here, we did breach important technicals, and we could hit, there is a number, I don't know where it is, but it is definitely in the southern destination. Once this number is hit, the algos will trigger stop orders, creating an avalanche of selling that will coincide with a lot of margin calls to the Robin Hoodiots who've been gambling with margin. That would create a massive snowballing avalanche effect to the downside, and you could see one of the most epic sell-offs that you've ever seen in the stock market. Where is the number? I don't know, but understand that the algos are in control, and if we continue to sell off impulsively, triggering algos, that could be a disaster for the stock market. And of course, we need an event like this, maybe not to the same dangerous and damaging magnitude, but we need a resumption of the correction and the sell-off, because we haven't done enough to scare the Robin Hoodiots and the gamblers away from this market. In my opinion, watching the market's action this week and last week, what we have witnessed is just the beginning of the correction. There is one more shoe to drop, and it will create a bigger leg down, so watch out for that one. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.